As of 9:58 a.m. Eastern Time on October 30th, Alphabet's Class C shares, ticker GOOG, are trading at $288.40. That is a significant move up, currently higher by $13.23 or 4.81% on the day. This is not just a random intraday rally. What we are seeing this morning is the market's direct and frankly stunned reaction to the earnings report Alphabet dropped after the bell last night. The expectation going into this quarter was one of intense scrutiny. The narrative was defined by fear. Fear that the artificial intelligence race was just a massive cash burn. Fear that the core advertising business was stagnating under competitive and economic pressure. And overarching fear of the ongoing regulatory battles. The market was bracing for good, but not great. The reality, however, was a complete blowout. Alphabet did not just beat estimates, it reported its first ever $100 billion revenue quarter. Let's break down those staggering numbers. Wall Street was looking for revenue around $99.9 billion. Alphabet delivered $102.35 billion. Analysts were projecting earnings per share around $2.26. The company posted an adjusted $3.10. This was a top-to-bottom dismantling of the bear thesis. This morning's 4.8% surge is a direct repricing of the company's value based on this new reality. The 8% jump we saw in pre-market trading set the stage, and the volume we're seeing now, just after the opening bell, confirms this is institutional buying. This is the movement of large funds being forced to recalculate their models. The most critical part of this report, the one that completely changes the narrative, is Google Cloud. For years, cloud has been the promising but distant third-place competitor to Amazon's AWS and Microsoft's Azure. The expectation was that it was growing, but the question was whether it could ever be truly profitable and competitive at the highest level, especially with the massive capital outlay for AI. The reality, as shown in this report, is that Google Cloud revenue surged an incredible 35% to $15.15 billion, blowing past estimates. Even more importantly, the company revealed a $155 billion backlog for its cloud services. This is not speculative future income. This is a pipeline of contractually obligated revenue. This single data point proves that the company's aggressive investment in AI infrastructure is not just a defensive measure against competitors, it is a new primary engine for offensive growth. At the same time, the report silenced the other major bear argument, that AI would cannibalize its own core search business. The fear was that new AI-driven search models would be too expensive to run and would destroy the high-margin advertising model. The reality? Google search revenue grew 15% year over year. YouTube advertising also beat expectations, coming in at $10.26 billion. The company proved that its core business is not only resilient, but is accelerating, all while its new businesses are scaling at a remarkable rate. The advertising cash cow is funding the creation of the next empire in real time, and both are thriving. In response to this success, management's commentary was not of quiet relief, but of aggressive confidence. They did not announce cost-cutting or a pullback. Instead, they announced they are raising their 2025 capital expenditure guidance to a range of $91 to $93 billion, up from a previous $85 billion. This is a clear signal to the market. The AI spending is working, the return on investment is visible, and they are stepping on the accelerator. They are building the data centers and the infrastructure to meet that $155 billion backlog and whatever comes after it. This is a massive pivot from the market's expectation of a company bracing for a margin squeeze. Now, this brings up a crucial topic, especially given the market volatility, the short-selling landscape. When we talk about short interest, many retail investors immediately think of heavily embattled meme stocks with 30, 40, or 50% of the float short sold, creating the potential for a massive squeeze. A mega-cap behemoth like Alphabet is a completely different animal. The short thesis here is not and has never been about bankruptcy. It is a far more sophisticated bet. The bear case for Alphabet has long centered on two main pillars: valuation and regulation. The short argument was that the company's valuation was unsustainable if its core ad business was under threat. Furthermore, the massive overhang of the Department of Justice antitrust case, which many feared could lead to a forced breakup of the company, gave bears a structural reason to bet against it. A mild ruling in that case last month had already weakened that thesis, and last night's earnings report delivered a critical blow to the valuation argument. All of those positions betting on a sell the news earnings disappointment are now in a significant amount of pain. For an investor trying to understand this, it is important to know where to look. You do not have to guess. The first, most basic place is the official short interest data published by FINRA every 2 weeks. For a stock like GOOG, this percentage of the float shorted is almost always in the low single digits. It is not a squeeze play. The more telling metric, one that specialized data providers track, is the cost to borrow. This is the interest rate or fee that a fund must pay to borrow shares to sell them short. For Alphabet, this fee is almost minuscule, meaning the stock is easy and cheap to short. A sudden spike in that borrow rate would be your first signal that institutional demand to bet against the stock is rising sharply. Another key metric is days to cover, which is the total short interest divided by the average daily trading volume. For Alphabet, this number is typically very low, perhaps 1 or 2 days, meaning all short positions could theoretically be closed out quickly without causing a massive price spike. You can also monitor fails to deliver or FTD data from the SEC, which shows when a party fails to deliver shares to complete a trade, sometimes a signal of naked short selling, though it's a complex and often misunderstood metric. In reality, the most sophisticated short bets against a giant like Alphabet are not even made by shorting the common stock. They are placed in the options market through the purchase of long-dated put options, which is a bet that the stock will be lower by a certain date. What today's 4.8% upward gap demonstrates is that all of these bearish positions, whether in common stock or complex derivatives, are now under immense pressure as the market is forced to price in a $100 billion quarter. This brings up a question I want you to comment on below, as it sits at the heart of this new valuation. What's your take on the massive $93 billion capital expenditure plan? Is it a necessary investment for technological dominance, or is it a sign of risky, margin-crushing spending that bears are right to question? Before this report, the sentiment we saw on forums and social media platforms was deeply divided. You had the AI bulls who believed in the long-term vision, and you had the search is dead bears who were convinced the company was a falling knife. The 30% rally we saw since the legal clarity in September had many calling for a pullback, arguing the stock was overbought. Last night, that entire conversation was reset. The $100 billion headline is a powerful, simple, and overwhelmingly bullish narrative that has galvanized retail and institutional investors alike. So, what does all this mean for the path forward? We must shift our framework. The expectation was that Alphabet was a mature giant in a defensive battle to protect its legacy businesses. The reality, as proven by this quarter, is that it is an offensive juggernaut, simultaneously accelerating its core business while successfully building its next one. The $155 billion cloud backlog provides a clear line of sight for revenue growth for years to come. The continued resilience of search and YouTube provides the cash flow to fund it. The risk is no longer will the AI investment pay off. The new risk is can they manage the operational and margin implications of this explosive high-cost growth. That $93 billion capex figure is the new number to watch. It is an enormous bet. But it is a bet made from a position of strength, backed by a fortress balance sheet and two of the most dominant platforms in the world. To be clear, Alphabet is a complex entity. It is not just Google. It is the Google search engine, the Android operating system, the YouTube video platform, the rapidly growing Google Cloud, and the Other Bets division, which houses moonshots like the autonomous driving company Waymo. The business model has always been anchored in advertising, but this quarter marks the most significant validation to date that the company's second act, cloud and AI, is not just a supporting player, but a co-star. Comment below with your thoughts on what you believe is the biggest driver for Alphabet's future. Is it the continued dominance and AI integration of search, or is it the high-speed growth of Google Cloud? In conclusion, this morning's price action is a reflection of a fundamental reevaluation. The expectation was that Alphabet was spending billions to defend its moat. The reality is that it's spending billions to build new oceans. The market was looking for signs of weakness and was instead shown overwhelming strength. The narrative has shifted from defense to offense, and that is why Alphabet stock is soaring today.